In March 2026, Australia's financial regulator, APRA, released a report that quietly sent a shockwave through the property industry. The headline finding? Right now, approximately 1 in 7 Australian homes is already uninsured. And by 2050, APRA projects that number will jump to 1 in 4, roughly 1 million additional families losing insurance coverage over the next 25 years. That's around 40,000 households every single year. But here's what the report didn't say loudly enough. This isn't a future problem. It's already hitting Sydney's waterfront suburbs right now, and it's showing up in the property numbers. So let's break down what's actually happening, why it matters, and what it could mean for buyers, sellers, and investors watching this market closely.
Sydney has quietly become the most expensively insured city in Australia for homeowners. As of October 2025, the average home insurance premium in Sydney sat at $3,964 per year, second only to Darwin nationally and significantly higher than Melbourne, Brisbane, and every other capital city. But that's just the average. For waterfront and harbour-facing properties, the kind in Mossman, Balmain, Manly, and along the inner harbour precincts, it gets much worse. According to specialists in the luxury property insurance market, Sydney insurers are no longer pricing policies by postcode alone. In 2026, they're going street by street, elevation by elevation. A home 5 metres from the waterfront is now being assessed completely differently from one 500 metres away, and the gap in premiums reflects that. In high-risk flood zones across Australia, the Insurance Council of Australia confirmed in 2025 that flood insurance components alone can run between $7,000 and $30,000 per year. For homes sitting at low elevation near Sydney Harbour or on tidal waterways, those numbers are no longer out of reach. And here's where it starts to hit property values directly. When insurance becomes that expensive, buyers start doing the maths before they make an offer.
Let's look at what the data shows. Over the past 5 years, the average Australian home insurance premium has gone up 51%. In 2020, the national average was $1,940 per year. By October 2025, according to data analytics firm Finity, it had risen to $2,938. That pace has outrun general inflation by a significant margin. In 2025 alone, CanStar data shows the average home and contents premium jumped another 14%, rising from $2,452 to $2,795. Some areas saw increases of up to 17%, adding around $700 to annual bills in a single renewal cycle. Meanwhile, a late 2025 survey by 9.com.au found that 3/4 of Australians expected premiums to rise further in 2026. More than half said they'd already experienced an increase the previous year. And a YouGov survey commissioned by the Climate Council in January 2026 found that 54% of insured respondents were worried that storms, floods, and bushfires could make home insurance unaffordable or simply unavailable in their area. Now, overlay that with the Sydney property picture. As of April 2026, Sydney's median dwelling price was approximately $1.29 million. Detached houses were down 1.5% from their cyclical peak, with top-quartile properties, the exact bracket that includes most waterfront homes, declining for 5 consecutive months. ANZ Bank in April 2026 cut its Sydney price forecast and now expects values to finish 2026 down 0.7% overall. For premium stock near the water, the drop is steeper. The numbers are telling a clear story. Buyers are pulling back on expensive, high-risk coastal stock, and insurance costs are a meaningful part of why.
Here's where it gets tangible. Compare the Market ran pricing analysis and found a $2,853 gap between the cheapest and most expensive insurance quotes for the exact same property in Sans Souci, a bayside suburb in Sydney's south. Same house, same risk profile, nearly $3,000 difference depending on which insurer you call. That kind of spread tells you how unsettled the market is and how differently companies are assessing coastal risk in real time. The Australia Institute estimated in 2025 that approximately 1.4 million Australian homes were already either uninsured or underinsured. Industry data from the Insurance Council of Australia puts the number even higher, around 1.8 million residential households with no building or contents cover at all. On top of that, ASIC has estimated that up to 80% of homeowners who do have insurance are underinsured relative to what it would actually cost to rebuild today. APRA's March 2026 stress test spelled out the trajectory in terms that are hard to ignore. Annual weather-related losses across Australia are projected to rise from under $7 billion today to more than $16 billion by 2050 under the higher emissions scenario, a 140% increase. Even under the lower emissions pathway, losses are expected to hit $12.4 billion. Between 2015 and 2024, 33% of economic losses from natural catastrophes in Australia were already uninsured. That's a financial system problem, but for someone buying a waterfront home in Sydney today, it's a very personal one. Before we get into the rental market and what this means for investors, if you're finding this breakdown useful, go ahead and hit that subscribe button.
So what are buyers, sellers and agents actually doing with this information? Agents in Sydney's premium suburbs are reporting that the questions buyers ask at inspection have changed. It used to be about body corporates, council approvals and strata fees. Now people are calling their broker before they make an offer to find out what the insurance will actually cost. For waterfront properties, that due diligence is turning some buyers around entirely. Investors are recalibrating too. Top-quartile Sydney property has seen 5 consecutive months of price declines heading into mid-2026. Consumer confidence, as measured by the ANZ Roy Morgan Index, recently recorded its lowest reading since tracking began in 1973. That's a combination of high mortgage rates, a broader cost of living squeeze, and for coastal buyers specifically, the additional weight of insurance. The Insurance Council of Australia has publicly called on governments to increase investment in flood defence systems, create a national hazard database, and reform taxes on insurance premiums, which currently inflate costs for policyholders in every state. So far, those calls are still largely unanswered. In the meantime, APRA has said it will provide the findings from its climate stress test directly to the federal government and to the National Emergency Management Authority. How quickly any of that translates to relief for homeowners is an open question.
As of right now, June 2026, the pressure on Sydney's waterfront housing market is building from multiple directions at once. Home values in Sydney slipped close to 1% in May 2026, with the national market stalling for the first time since January 2025. High-end detached housing is taking the hardest hit. Insurance premiums show no sign of reversing. The structural drivers, as the APRA report put it, are climate risk, rising rebuild costs, and reinsurance pricing. None of those have been resolved, and none are likely to ease quickly. Some respondents in late 2025 told pollsters they were already cutting their coverage just to manage costs. One said they couldn't afford insurance and food. Another said they'd never made a claim in 65 years and were about to cancel everything. That's where this market is right now, and that shift has every waterfront property owner, investor, and buyer watching closely.
That's why homeowners, renters, and investors are all on edge right now. The market is shifting faster than most people expected, and insurance costs are no longer a footnote in the conversation. For Sydney's waterfront suburbs especially, they're becoming the headline. If you found this useful, hit subscribe. There's more coming on how this plays out across Australia's most expensive property markets.